Moat Main, hedge fund thinking for your daily life. In 1949, a Columbia professor named Benjamin Graham published a book that almost nobody paid attention to. It wasn't flashy. It wasn't exciting. It didn't promise fast money. It was slow. Analytical. Almost boring. But over the next 70 years, that book would quietly shape how the smartest investors in the world think. Warren Buffett. Seth Klarman. Howard Marks. Not just how they made money, but how they avoided losing it. The book was The Intelligent Investor, and near the end, Graham was asked a simple question: if you had to reduce everything you've learned into just 3 words, what would they be? His answer: margin of safety. 3 words that sound technical, but actually describe a human need: room to be wrong without being ruined. Now here's what most people miss. This idea was never just about investing. It was about survival. Because the world you live in is full of hidden leverage. Rent that can't be negotiated. Bills that arrive on someone else's schedule. Jobs that disappear without asking permission. And when you're operating with no margin, life forces you into bad trades. You borrow when rates are worst. You sell when prices are worst. You accept terms you'd never accept if you had 1 extra month of breathing room. Because if you're earning $50,000 a year, living in America today, and one unexpected event can wipe you out financially, you don't have a spending problem. You have a margin of safety problem. Let's make this simple. Imagine something is worth $100. Most people think the smart move is to pay $100. Maybe $95 if they're being careful. Graham would say that's dangerous. Because what if you're wrong? What if it's actually worth $80? What if something changes tomorrow? So instead, you pay $60. That gap is your margin of safety. It's not profit. It's protection. And here's why that matters. In the real world, you almost never know the value with precision. You have estimates. You have assumptions. You have narratives that feel stable, until they aren't. So margin of safety is a way of saying, I'm allowed to be wrong, and still be okay. It's the distance between a bad month, and a bad decade. And protection feels uncomfortable. It feels like you're missing out. Like you're being too conservative. Like everyone else is moving faster than you. So people skip it. They optimize for upside, and ignore survival. But here's the rule nobody tells you: you don't get to compound, if you don't survive. Now apply that to your life. Let's say your monthly expenses are $3,000. Most people operate right at the edge. They earn $5,000, spend $4,500, and assume everything is fine. Until something breaks. The job disappears. The car fails. A medical bill shows up. And suddenly, there's no gap. No buffer. No margin of safety. And without that gap, every decision becomes urgent. You can't wait. You can't choose. You can't think clearly. You react. And urgency is expensive. It makes you take the first job offer instead of the right one. It makes you finance problems at the worst possible interest rate. It makes you sell investments at the exact moment you should be patient. Margin of safety doesn't remove risk. It changes your behavior when risk arrives. That's what margin of safety actually buys you. Not money. Time. Options. And the ability to stay calm, when other people panic. Benjamin Graham learned this the hard way. In 1929, he lost almost everything. And instead of quitting, he spent decades figuring out why. His conclusion was simple: you cannot predict the future. But you can prepare for it. He wrote, the function of margin of safety is to make accurate prediction unnecessary. Think about that. You don't need to be right. You just need to not be fragile. That's the entire point. If you require perfect timing, or a perfect boss, or a perfect economy, you are living on the edge of the bridge. He used an engineering analogy. If you build a bridge that can hold 30,000 pounds, you don't drive 30,000 pounds across it. You drive 10,000. That gap is what keeps the bridge from collapsing. Now look at modern life. Subscriptions. Car payments. Lifestyle upgrades. Each one feels small. But together, they increase the weight on your bridge. Until one day, you're operating at the limit. And that's when things break. Not gradually. Suddenly. And this is why a little lifestyle inflation is never just a little. It's weight you commit to carrying every month. It's a promise you made to your future self, without asking if your future self agrees. Warren Buffett took Graham's idea, and turned it into behavior. Because numbers alone don't protect you. Decisions do. Buffett understands something most people ignore: your life is a portfolio. Your time. Your attention. Your energy. Every time you say yes, you're spending them. Say yes too often, and your margin disappears. Your calendar fills up. Your thinking gets shallow. Your decisions get worse. That's why Buffett says, really successful people say no to almost everything. Because every no protects your margin. Not just financially. Mentally. And notice what that implies. Buffett also keeps cash when it looks unproductive. People criticize him for it. They say he's missing returns. But cash is a form of margin of safety. It lets you act when prices are low, instead of being forced to act when life is expensive. That's the difference between a choice and a scramble. When your calendar is full, you can't think long-term. You can only react short-term. But when you protect space, you regain the ability to wait. To read. To write down your assumptions. To make decisions when you're calm, rather than when you're cornered. And in a world full of noise, the person who can think clearly, wins. Graham builds margin with structure. Buffett protects it with behavior. Different approaches. Same idea. Margin of safety is the gap between what you need and what you have. The gap between what you expect and what could happen. And the wider that gap, the more options you have. And options are what turn chaos into calm. With options, you can negotiate. You can wait. You can walk away. Without options, everything becomes binary, yes or no. Now or never. Take it or lose. That's not strategy. That's pressure. So margin shows up in three places: cash margin, money you don't have to touch. Time margin, empty space where you can think. Attention margin, a mind that isn't constantly interrupted. You can be rich in one and bankrupt in the others. The goal is not perfection. It's non-fragility across the whole system. The more options you have, the less desperate you are. And the less desperate you are, the better your decisions become. Over time, that looks like intelligence. But it's not. It's margin. And that's why the people with margin look lucky. They can walk away. They can wait. They can say, not yet. They don't need the next thing to work out, because they're not relying on it to survive. So here's your allocation this week. First, calculate your real monthly expenses. Not ideal. Not optimistic. Real. Include the boring stuff people forget: annual premiums divided monthly, repairs, gifts, travel, the subscriptions you swear you'll cancel next month. Because margin of safety is built on reality, not intention. Second, build toward 6 months of expenses. Not 3. 6. That's your baseline margin. And if that number feels big, good. It's supposed to. Because the point isn't to feel safe on a normal day. The point is to stay functional on a bad one. Third, lower your fixed costs. Because lower cost means wider margin. This is the simplest lever most people ignore. You can't control layoffs. You can't control medical bills. But you can control how heavy your life is before they arrive. Fourth, say no to one unnecessary commitment. Protect your time. If you can't name your thinking time, it doesn't exist. So put it on your calendar like a meeting. Because that's where your future decisions are made. And fifth, remove one distraction. Because attention is margin too. If your attention is constantly rented out, your goals will always feel urgent and unclear. And unclear goals create fragile decisions. And here's the truth, margin of safety never feels urgent, until it's too late. The people who look calm, aren't lucky. They're prepared. They built space into their lives, before they needed it. And that space, lets them stay steady, when everything else moves. Margin of safety isn't about avoiding risk. It's about surviving it. And survival, is what allows everything else to compound. Not just money. Your health. Your relationships. Your career. Because when you have margin, you can choose the better option instead of the fastest option. And that's why margin is a rule, not a mood. You build it on boring days. You protect it when you feel optimistic. So when the real test arrives, you don't have to become a different person. You just execute what you already decided, when you weren't scared. 3 words. 1 philosophy. Margin of safety. A rule for investors, and for your life. So which margin do you need most right now? Cash, or attention? Comment 1 word below. And if you want more investor thinking applied to real life, subscribe. Next episode will take another classic idea, and translate it into a simple weekly rule you can actually follow. Moat Main. Hedge fund thinking for your daily life.